Over the past 12 months ending last Friday, the price of Bitcoin is up 487%. That's impressive to any investment market observer. However, that gain has likely been garnered more by younger investors and some early adopters in the big money crowd. The retiree or pre-retiree has probably spent much of the last year trying to determine how much stock volatility they can take on. After all, last Friday was the one-year anniversary of last year's S&P 500 top. 5 weeks later, as of March 23, 2020, that index had lost about one-third of its value. Then, it made it back, and more. That was about the fastest drop and fastest recovery of that magnitude investors have ever seen. Regardless of how the past 12 months have treated your portfolio, it should have been a great time to take account of your objectives and strategy as an investor. As noted above, and shown in the chart below, Bitcoin has been on a tear during that time, barely stopping to catch its breath and let new potential investors in. Regardless of what you think of the fundamental rationale for owning cryptocurrencies, the one thing that doesn't lie is price. And when it comes to price, Bitcoin has been a winner the past 12 months. However, if you are the type of investor that is reticent to place a big chunk of your fortune in something as speculative as the crypto space, I have some good news. There are other areas of the investment markets that are also breaking out in a way that you can consider taking advantage of. And their fundamental story is somewhat more tangible. One in particular is worth paying close attention to for multiple reasons. The chart above shows that gigantic move in Bitcoin, most of which occurred since last autumn. That's the orange line. You'll also notice a purple line that has increased in value by much more than Bitcoin over the same time period. And, like the spike in the price of Bitcoin, most of this move has taken place since last autumn. Yet I suspect the investors who most need to follow it are largely unaware. The purple line is the growth of the spread between the 10-year U.S. Treasury Bond and the 2-year U.S. Treasury Note, or the 10-to-2 spread, for short. In other words, this measures how much more yield you get for a 10-year bond versus a bond that matures in just 2 years. That spread was under 0.2% a year ago. As of last week, it was closer to 1.2%. And, it is rising at an increasing rate, as Bitcoin is. Now, you can't invest in the 10-to-2 spread directly as an asset, at least not easily. However, that's not the point. The key to retired and pre-retired investors is that the bond market is telling us something. Or rather, it is telling us a few things. Translation: the bond market doesn't care what the Fed is doing. It sees more risk of inflation, and it is taking action on its own. For what it's worth, the size of the bond market dwarfs that of the stock market. So we need to take notice.